Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 28th of May. I'm Daniel Lam, your host for the podcast. I love paradox. Yes, logic is very satisfying, but without paradoxes, the world would be so much less interesting. Now, one of the biggest stories in financial markets during the past 2 years has been the tightening of corporate bond spreads against a backdrop of high interest rates and increasingly restrictive bank lending standards in the US. Now, what makes the spread move even more puzzling is that defaults have been climbing as spreads have tightened. So the 12-month speculative grade default rate is now nearly 6%, up from a 2022 low of 1.2%. So how do we decode all these? Well, the fall in gross leverage, i.e. the total corporate debt divided by pre-tax profits, can explain the currently tight spread levels. So gross leverage is at its third percentile since 1989, and investment-grade corporate bond spreads at their 16th percentile. So what about the rising default rate? Well, the most likely explanation is that there is an unusually large dispersion between the balance sheet quality of high-rated firms able to withstand today's interest rate environment and the low-rated firms that are running into problems. The default rate is being pushed up by a few low-rated companies unable to refinance their debts. But this distress is not yet translating into balance sheet deterioration further up the credit spectrum. So, case in point is that high-yield downgrades have been outpacing upgrades consistently since early last year, while investment-grade credit is the other way around. Furthermore, we observe that the recent increase in the default rate has coincided with a rise in the percentage of the junk index that is rated CAA or below. So this divergence between high-quality and low-quality credits is also reflected in corporate bond spreads. So the spreads for corporate bonds rated B or above have already tightened back to 2021 lows. But the average CAA-rated spread still remains nearly 300 basis points above its 2021 low. So now the key question is, will this weakness pass through to higher-rated credits? Well, the empirical data shows a tendency for the quality spread between CAA and BA-rated bonds to lead changes in the overall junk spread. Rating trends also support the theory that fundamental changes in balance sheet health happen first at the low end of the credit spectrum and then gradually working their way up. So therefore, our preference in fixed income lies in EM US dollar government bonds, because we believe the interest rate cycle is somewhat different in EM versus the US. Some of the key EMs are now in a position to be ready to cut interest rates, giving a more friendly environment for fixed income compared to the US. Also, the improving manufacturing PMI data is also lending tailwind to EM fixed income. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.